Hello, this is Mijun from Beer Ceylon University. Let's start today's Beer Ceylon news for December 2nd. Welcome back to Mijun, where we consistently uphold the basics of investing in United States stocks. It's been quite a while since I set the concept of the Mijun broadcast as a news program. That's why at the beginning of the broadcast, I greet you by saying, let's start today's United States stock news. However, lately, I've been wondering if the title, Today's United States Stock News, is still appropriate. Because I've been taking more and more days off from the broadcast lately. I'm not sure if you've noticed why I'm bringing this up. This week, I have a really important schedule for 3 consecutive days, Wednesday, Thursday, and Friday. So, I'll do my best. But there's a high chance that there won't be any Mijun broadcasts for those 3 days. Wednesday, Thursday, and Friday this week. Meanwhile, Chief Executive Officer Kim In-jung will upload a video. There's a high chance that you won't be able to watch the Mijun broadcast hosted by me for those 3 days. I apologize for this in advance. There was one thing I sincerely wished for when I became a full-time YouTuber. I wanted to spend more time with my kids, so I often thought about being involved in their growth and becoming a part of their lives. So lately, I'm actually in the process of making that dream come true. Please keep this in mind, everyone, so don't get annoyed and wonder why I take breaks from broadcasting so often. I'm just doing my best to be a good dad, so I hope you can see it in a positive light. And as I've mentioned repeatedly lately, honestly, when I do news broadcasts, even the Mijun YouTube channel loses a lot of competitiveness. These days, there are so many media outlets where you can get real-time United States stock news. Even on sites like Nava, almost all the news is being delivered, and now it seems that Korean broadcasters are also quickly sending out news related to United States stocks. That's why I also feel the need to redefine the identity of the Mijun YouTube channel. And recently, many of you have been joining various memberships. For example, in the case of investing.com, all the articles are displayed in Korean, right? So if you look here, there's also a news section. Or if you register your favorite stocks, it can be a very useful tool. In my case, besides the United States stock portfolio, I've put all the stocks I'm personally interested in here. That way, any news related to the portfolio is displayed down here. So there's no need to go around looking for news for each stock individually. The fact that investing.com has this feature, I think it would be good for those who recently signed up to try using it. And about the investing.com discount. The deadline is tomorrow. It's available until December 3rd, so please keep that in mind. And for those who join Choicita, these days you don't need to go anywhere else because of the articles. Because there's a news discovery tab here, and if you click on it, a variety of news articles will pop up. So, Chief Executive Officer Kim In-jung has been paying a lot of attention to this news section lately. That's why I can say that there's almost no news you can't find here. And it's not just news that's displayed here. There's also an investment note here. So everything from earnings, company analysis, research to lifestyle videos is all organized here. It would be good for those using ChoiceStar to refer to this. Also, many members of Seeking Alpha are on the Mizon channel. Seeking Alpha does have one drawback. The number of news articles is truly outstanding. There is no news that isn't on Seeking Alpha. It's to the point where I can say that all news related to the United States stock market is covered here. One problem is that until now it hasn't been available in Korean. But let me give you a tip. Now, thanks to artificial intelligence, you can read articles in Korean. If you look at the top right here, you'll see an icon. If you click this icon, a menu will appear. Among these menu options, there's something called account setting. Click on that, and if you scroll all the way down to the bottom of account setting, you'll see language here. Only 2 languages are provided worldwide, and one of them is English. The other language is Korean. Now, this is the power of Mijuwon. So many of you have signed up for Sicken Alpha that the Sicken Alpha team made Korean the default language instead of English. So now we've entered an era where you can read articles in Korean. So now when you click on an article, it immediately appears in Korean. Of course, the main page is still in English for now. I hope this part will be resolved soon. Maybe that's too much to ask right now. But as you can see from the titles, if you see Amazon, which you're investing in, you can just click here. Please note that all the content of these articles will be provided in Korean. All right, then let's get started with today's Big 2 news prepared for December 2nd. Today, as always, I'll start by answering a question left by one of our valued subscribers. Yesterday on the broadcast, I gave a lengthy explanation while emphasizing the importance of cutting losses. So personally, I was a bit worried that I might be encouraging cutting losses too much and promoting it too strongly. Still, I think it's important for us to clearly understand this issue before moving on. So today, I've also selected a related question. This question was submitted about 7 hours ago by someone using the identification Francesca Kim. I'd like to ask a foolish question. If you've lost a lot in stocks, endure and wait if the future looks good. But if it's hopeless, recover what you can and invest elsewhere. That's right. If you have some extra funds, you could average down. After matching the average price, if you sell all, would the loss still be reduced? Sorry if my question is inappropriate. I'm just asking because I'm curious. I ask for your understanding. It's a very basic question, but I think it's an important one. It's something we can easily misunderstand. For a long time, I haven't really looked at the returns of each asset, and I don't even pay much attention to the returns of the portfolio itself. Personally, I believe that not focusing on returns is very important. We can find the reason in this question. Let me give you a similar example. Let's say we invested 10 million won in a stock called A, but it got cut in half and dropped by 50%, so it went down to 5 million won. In that case, the return rate is minus 50%. In these cases, many people try to average down, which means when you get your salary or make money from your business and save up 10 million won, you put this new 10 million won into the same stock again. When you do that, your total investment is 20 million won. You invested 10 million won at first, and then you put in another 10 million won the second time. So you invested a total of 20 million won. But since 5 million won decreased, now if you add 5 million won, the money left from 10 million won is 15 million won. In that case, the rate of return, which was originally minus 50%, suddenly improves to minus 25%. A lot of people keep averaging down just to feel this way, but you've seen two mistakes here. The first is just because you average down, it doesn't change the results up to yesterday. If we invested 10 million won and it fell 50% by yesterday, that investment is done. So investing in stock A yesterday and investing in it today are actually two separate bets. Yesterday's bet ended with a minus 50%. A 5 million won loss, and then you put in 10 million won today, right? You're starting again from 0%. What I'm saying is you shouldn't combine these. Your investment from yesterday is down 50%, but anything you invest today starts fresh at 0%. Remember this. The second mistake is this. If you want to put another 10 million won into a stock that failed until yesterday, there should be only one reason for it. Looking at it now, even though it dropped a lot to minus 50% until yesterday, at this point, stock A looks like the best option. In that case, adding another 10 million won doesn't matter. The issue is you bought it to average down. What that means is, since my current return is minus 50%, I decided to buy this stock again to dilute that loss. Now, your investment decision is based on your return, not the company's quality. A company's stock price rises when its growth rate increases. The market expands, competitiveness improves, and it gains economic advantages. As positive news continues, the stock price climbs. You should choose stocks based on these factors, but when you average down, your selection criteria become your own return. That's why you end up making a second mistake. You can see it that way. I once said that picking stocks is similar to horse racing. Averaging down is like betting a horse will win today just because it lost yesterday, assuming its chances have improved after losing. I think that's a very flawed logic. Yesterday, a certain horse came in last place. There must have been a reason for it to come in last, right? It's probably because it has very little stamina, or maybe it hasn't been trained properly lately, or it's overweight, or maybe it's sick. There must be some reason it keeps coming in last place. Just because it finished last yesterday doesn't mean betting it will win today is wise. The horse that won yesterday is more likely to win again today. We call these fundamentals, which are reflected in stock prices. So if a stock price has been continuously rising recently, it's likely that this stock will continue to rise today and tomorrow as well. Of course, that's what I mean. It used to be slim, but after eating a lot and gaining weight, it may slow down. It could also lose ability if it gets sick, or its speed might gradually decrease with age. Various problems can occur, but it's not like those things happen all of a sudden. So when we invest in a company, we keep checking the news and watch for any changes in this stock or this company. Whether it's getting sick, losing strength, or having some kind of problem, we keep researching and studying about this matter. I can adjust my investment ratio up or down. Without this kind of process, just thinking, I invested and it's down 50%, so I should buy more. I want to emphasize again that making investment decisions like this is very risky. I'll also summarize yesterday's United States stock market. First, if you look at the S&P 500 map, the atmosphere changed in a single day. Until just yesterday, the United States stock market had been on an upward trend all week, and everything was in the green. But today, suddenly, red is dominating the market. That means only a very limited number of stocks went up, so some funds have left the market. So we're seeing a very unfavorable situation where liquidity is shrinking. Honestly, it would be better for investors if the tech stocks we're investing in went down while other stocks went up. That's what I want to say. Now, I'd like to start by explaining why so many stocks and sectors have fallen together. Yesterday, I sent out a breaking news update to our members. Japan's government bond yields have surged to their highest level since 2008. Now, let me explain a bit more about what this means. Japan's government bond yields, which have soared to their highest levels since 2008, rippled through global markets on Monday. This has sparked concerns about yen carry trades and is pressuring risk assets overall, according to the report. Bank of Japan refers to the Bank of Japan, right? Governor Kazuo Ueda, after hinting at a rate hike this month, Japanese government bonds were heavily sold. When we say government bonds were sold, it means the price of government bonds fell because they became less popular. So the yield on Japanese government bonds surged. That's how you should see it. So, what happened to the 2-year yield, which reacts most to policy expectations? It rose by 3 basis points to reach 1.02%. This is the highest level above 1% since 2008. Now, the 10-year yield, which serves as the benchmark interest rate, jumped 7 basis points to 1.87%, also marking the highest level since 2008. So we know that Japan's government bond yields have risen to their highest levels since 2008, but let me explain why this is such a big problem. Now, I've summarized it in a few words for you. What about the situation where Japan's 2-year government bond yield has risen to 1.02%? It is definitely creating a change in the short-term interest rate environment. Now, considering that the United States 2-year government bond has matured and the bond yield still remains at around 3.5%, the government bond has matured. Considering this point, the bond yield. 2. The interest rate gap between countries is still 2.5%. 2. The interest rate gap between the two countries remains 2. 5. The interest rate gap is still 2. The gap still applies at 5. United States government bond yields were up to 3% or 4% higher than Japan's. That's why even if you borrow money to invest, you can secure a certain safety margin. That's why Japan's interest rates dropped to negative levels in the past and stayed at zero interest rates for a very long time. At that time, a huge amount of Japanese capital flowed into the United States. There's almost no cost to borrowing money. Zero interest rate means there's no interest. So, by barely paying any interest and using leverage to invest that money in United States stocks, you could earn an annual return of 10%. That's why a significant amount of capital flowed into the United States in that way. But the issue is that Japanese government bond yields, previously under 1%, have now climbed to 1.02%. That means the gap between United States government bond yields and Japanese government bond yields is gradually narrowing. That's how you can explain it. When you examine these interest rates, the spread is simply the difference between them. If you look at the difference between the two interest rates, the basic structure of the traditional yen carry trade is to borrow at a low interest rate in Japan and invest in United States assets or United States Treasury bonds. This strategy is still theoretically attractive, because the yield on Japanese government bonds is still only about 1%. So if you borrow money at 1% and use leverage to invest in United States assets, you can get 3 to 5% interest. You can still make a 2 to 5% profit. So while it's true that the interest rate gap has definitely narrowed, theoretically it hasn't shrunk to the point where the carry trade itself would collapse. But there's one problem. Whether or not a carry trade unwinding occurs isn't determined solely by the interest rate gap. There's another variable we need to watch. What is it? It's the phenomenon of yen appreciation. Even if there's a 2% difference, even if you can raise the interest rate gap by 2%, if the value of the yen keeps rising and the value of the dollar falls, then that yield becomes meaningless. This has become a factor undermining yen weakness, which was central to the yen carry trade and ultra-low interest rate funding. The reason why Japanese funds kept flowing into the United States market for a while was because there were two very big factors. The main reason is ultra-low interest rates. Borrowing money in Japan had almost no interest cost. The second reason is because the yen kept weakening. So if you had dollars, the value of the dollar kept going up, so you could get a double benefit. But now, the value of the dollar is falling and interest rates are actually rising. So that's becoming a problem. That's how you can see it. So I've organized some practical response strategies that investors should consider in the current situation. If you don't have any cash at all, it might be a good idea to increase your cash holdings a bit. And if you're only invested in highly valued tech stocks or cryptocurrencies, you'll need to adjust your portfolio allocation. Cryptocurrency prices often fluctuate due to interest rates, and there's nothing that truly determines their value. Since there are no fundamentals, the most important thing is the macro environment, especially whether interest rates are rising or falling. That's what determines their fate. So if cryptocurrencies make up 50% of your entire portfolio, that's quite risky. There's a need to reduce the proportion. That's my personal opinion. Going forward, we should monitor changes in the United States dollar, South Korean, won exchange rate, and 10-year United States Treasury bond yield fluctuations. If Japanese interest rates keep rising and United States Treasury yields also go up, then the valuations of our favorite growth stocks and artificial intelligence beneficiary stocks will inevitably fall. This is also something we need to take into consideration. But at the end, I wrote jup, right? The reason is the issue we're talking about right now isn't essentially the collapse of the financial system. It's not that there's a problem with the financial system. It's about the movement of funds. The United States market was once more attractive, but as its appeal declined and Japan's increased, some funds shifted there. That's the way to see it. Therefore, there's no change in global liquidity. As I mentioned earlier, while looking at the S&P 500 map, it's a problem if money is flowing out overall. But funds moving back and forth between sectors isn't a huge issue. That's how you should understand it. If the United States economy, including employment, consumption, and gross domestic product, is strong, then a yen carry trade unwinding crash is just a temporary supply and demand shock. That's how you should view it. It just means it's a correction. Personally, I think a bear market is unlikely. In fact, there have been major liquidation events in the past. There was one in 1998 and another one we experienced together last year. There was also a huge crash in August 2024, and that was a sharp drop caused by supply and demand issues. At that time, it was a good chance for us to buy Yangdu cheaply. Back then, it dropped sharply, then quickly shot up again. So when the yen carry trade is liquidated like this, the correction that appears usually doesn't last long. We know this well. So rather than panic selling in fear, I want to suggest that the best response is to focus on fundamentals, like whether the companies you own still have solid earnings and not too much debt, and continue investing based on that. Yesterday, one of the United States top pick companies announced its earnings, and that was Credo Technology. Today, I'll share the earnings results of Credo Technology with you. Because yesterday it plunged by 3.64%, but after the earnings were announced, as you can see here, the stock price soared by 14.8% in after-hours trading. Just how good were the earnings for the stock price to rebound like this? I'll provide you with detailed information on why the stock is suddenly rising by nearly 15%. I've written an article about this, but before I introduce it to you, first, I asked Warren Artificial Intelligence about it. Recently, I've been testing Warren Artificial Intelligence on investing. So I asked it to analyze the earnings results for Credo Technology's fiscal year 2026 Q2, which were just announced. It offers a detailed analysis. It goes on to explain things like how the revenue is, what the earnings per share is, what the engine of cash and stock price growth is, and how margins, financial stability, and growth are being supported. There's also a graph here. The red line represents the earnings before interest, taxes, depreciation, and amortization margin, and the blue line below shows the cash flow. So this is the operating cash flow. If you look at the operating cash flow, until just recently, it was around 0%. If you look to the left, it was going back and forth at 0%, moving from percent to percent and from percent to 0%. Light. For now, I think the article I wrote is a bit cleaner. So I'd like to share and explain the article I posted on the Mijuan membership with you all. I wrote that this is the perfect cause and effect of Cred Technology. There's really nothing to criticize. Let's take a look. First, let's check out some numbers. The sales figures are shown first. It recorded $268 million. That's $268 million. It's hard to judge how impressive this number is just by its absolute value. But if you look at the year-over-year growth rate, it's plus 272%, not 27.2, but 272%. And even compared to the previous quarter, it's showing a plus 20%. Usually, if a company grows by just 20% year-over-year, we consider that an impressive growth rate. But this company is growing by 20% every 3 months. It's truly a remarkable growth stock. And compared to market expectations, the growth rate was actually 14% higher. So, the current sales growth is consistently coming in much higher than what the market expects. That's how you should see it. Secondly, regarding margins, the generally accepted accounting principles, gross margin is at 67.5%, and even on a non-generally accepted accounting principles basis, it's 67.7%. And this level, compared to last year, was 63.2 and 63.6. So these are much higher margin figures being reported. Because their gross margin is rising, they have strong pricing power, which results in higher prices. That way, the margin can go up. There's one more thing. It reflects an improvement in the product mix. What does it mean for the product mix to improve? When you sell various products, some have high margins and some have low margins. But in the case of Credo right now, the proportion of revenue coming from products with very high margins is increasing. That's how you can look at it. Well, of course, recently there's been a shortage of artificial intelligence related products. They can't sell them because they don't have enough in stock. Credo Technology's network solutions have recently seen rising demand, causing notable price increases and creating a chance to enhance their product mix. That's the perspective you should have. Operating profit is now $78.8 million compared to last year's minus $8.4 million. A year ago, this company had a negative operating profit, but now they're generating a huge $78.8 million in operating profit. The company's fundamentals have fully improved. The non-generally accepted accounting principles earnings per share is $0.67, while the market expectation was 0.5. So, you can see that the company is performing much better than expected, not only in revenue, but also in earnings per share and net profit. Next is cash flow and finances. Cash and short-term assets have risen to over $800 million. They now have much stronger financial flexibility and plenty of cash. And they are maintaining a net cash structure with almost no debt. Now, if you have this much cash and no debt, there are a lot of things you can do with that cash. For example, you could repurchase your shares or acquire another company. There's also the option to acquire or merge with a good company. In addition, they can invest a lot of money to further develop their technology. You can see that they also have the capacity to increase their R&D expenses. So the quality of their performance is very high. It's not just that their sales have increased. It was a very meaningful quarter where margins, cash, and profits all improved together. That concludes the numerical analysis. Even with strong earnings, poor guidance can cause a stock to fall. Here, though, the guidance was also excellent. For the next quarter, they expect sales of about $3.4 billion, between $3.35 and $3.45 billion. If so, that's a 25% to 29% increase from this quarter. I just showed you the earnings results and said that there was a 20% growth compared to last quarter, and that it was amazing. It rose 20% from last quarter, and they're expecting another 25% to 29% increase next quarter. That's an incredible guidance. The gross profit margin is 64 to 66. It drops slightly but remains high. So both in terms of sales and margin, they're above market expectations. The demand for building artificial intelligence infrastructure is not a short-term event. So we can see from Credo's earnings results that structural growth is happening in artificial intelligence right now. Recently, the rules for large-scale artificial intelligence training clusters have been accelerating. They call it an artificial intelligence factory, right? Recently, artificial intelligence data centers have grown so large that they're now being called artificial intelligence factories. Now, along with that, Credo's core products like AEC and optical digital signal processor, as well as various other products that Credo sells, are all related to artificial intelligence. So you can see that the guidance reflects the fact that they've started to fully benefit from this. To summarize the business structure characteristics in this earnings report. First of all, Credo Technology has 3 growth engines, and all 3 are used in artificial intelligence data centers. The first is the active electrical cable. It's called AEC. It's a high bandwidth, low power product for AIC servers designed for low power consumption between AIC servers. It's currently being rapidly adopted across data centers very quickly. That's because it's a cable that connects servers, and this cable maintains a very high bandwidth while consuming very little power. These days, products that use less power are extremely important. Therefore, there are now many companies that want Credo Technologies cables, and the number of customers continues to increase. That's how you can see it. That's not all. Besides AEC, there are also things like optical digital signal processor and something called zero-flop optics. As artificial intelligence clusters grow in size, there are limitations with just traditional electrical cables, so the proportion of optical connection solutions is increasing. So while Credo's main product right now is AEC, you can see that their second main product is also selling a lot. In particular, Credo's zero-flap technology is said to have strengths in solving link stability issues. The third product is chiplet IP. IP stands for intellectual property. They sell licenses, which make up a large share of their revenue. That's how it works. Credo, the chief executive officer, says this. This quarter is the strongest quarter in the company's history, and he emphasizes that demand for Credo's product lineup is rapidly increasing as the world's largest artificial intelligence training and deployment clusters are being built. Here, we can also observe the stages of the artificial intelligence revolution. Until just recently, we were only at the stage of training artificial intelligence. But now, artificial intelligence training is still ongoing, and additionally, deployment clusters are being created. As a result, data centers for deployment are also continuously increasing. As these data centers grow exponentially, the amount of computing power is also increasing. But in that process, we need to remember just how many cables are required. Next, let's move on to customer concentration. In fact, this is practically the only weakness of Credo Technology. Especially in the past, there were times when a single hyperscaler accounted for 60% to 80% of the revenue. Even though we say this was in the past, in reality, it was like this just a few quarters ago. At that time, the specific hyperscaler was estimated to be Amazon. What that means is, if Cred were to lose Amazon, 60% to 80% of Cred's revenue could suddenly disappear. That was the level of risk Cred carried as a company. However, recently, the top revenue clients have been diversified from 3 to 4 companies. The issue of excessive concentration appears to be easing. And it's not just the number of clients that's increasing. All 4 of these clients are said to contribute more than 10% of the revenue each. Therefore, the biggest risk is gradually being resolved. Of course, if there are still only 3 or 4 clients, the client base is still limited. So if you lose even one of them, it would be a significant blow. If a certain major client's capital expenditures is reduced, or if they develop their own connectivity solution, that would cause problems. So you can see that the structural issue of Cred's short-term performance volatility still remains for now. Here's a summary of market and media reactions. The market responded positively right after the earnings announcement. Thanks to that, the stock price rose more than 14.8% in after-hours trading. Also, various media outlets reported that it was an earnings beat that far exceeded expectations. Cred is the main beneficiary of the artificial intelligence infrastructure boom, with strong guidance reinforcing their leadership. They view it this positively. That's why the stock price has already gone up more than 250% over the past year. And even after that, the fact that there could be an additional increase of nearly 15% is because the quality of the earnings and the guidance far exceeded market expectations. So I think that's why we can sum it up like this. This time, Credo Technologies' earnings matched expectations in growth, profitability, cash generation, and guidance. In short, they delivered perfect results. In artificial intelligence data centers, particularly in back-end networks and high bandwidth, low-power connectivity, Credo is proving to be more than just a thematic stock. What that means is the performance keeps backing it up. Every quarter, the results are up by 20%, 25% compared to the previous quarter. So now Credo is one of the most important companies among the core artificial intelligence companies. This fact was confirmed in this announcement. That's how you can see it. The last content prepared for today is news related to Nvidia. Yesterday, there was another big piece of news related to Nvidia. Nvidia has surprisingly acquired a $2 billion stake in Shin Office. Recently, Nvidia has been freely spending the cash it has on hand. I could explain the significance of this news myself, but today I prepared an interview video featuring Jensen Huang. Jensen Huang, this part. If you say it like Makinahe Jining test, Toki test like this, quantum synchrotest treatment, and if I fail to make the video, I'll make sure to greet you again on next week's broadcast. Let's all keep fighting together until the day we all retire through investing in United States stocks. Have a happy day. Thank you.
If we didn't know the synopsis, I would have asked this. Artificial intelligence spending for data centers now far exceeds the cash flow of some key companies like Oracle and Open Artificial Intelligence. Aren't you worried about that? And shouldn't one of OpenAI's investments have been a bit more cautious? Questions like these. Questions about whether the capital investments of hyperscalers are really sustainable. Are these simply competitions and questions unrelated to the core of the fourth industrial revolution you described?
You probably know well that most people only see the tip of the iceberg and only a part of the whole picture. The fundamental change happening right now is that the platform itself is shifting from traditional central processing unit-based computing to GPU-based accelerated computing. Of course, the traditional methods will remain, but the trend is already shifting toward the new way. It's actually this platform transition that is being supported by the cash flow of hyperscalers around the world. Whether or not there is agentic artificial intelligence, whether or not chatbots have appeared, this transition would have happened anyway, because the GPU-based method is much more efficient. General-purpose computing has honestly reached its limits, and with Moore's law slowing down significantly, we now need more powerful and advanced computing methods going forward. Another important point is artificial intelligence. This is the current conventional method. This is the method, the current conventional. This is the current method. This is the method. This is the current method. This is the current conventional method. This is the current conventional. This is the conventional current method. This is the current conventional method. This is the current conventional method. This is the current conventional method. Since we don't have to use the engineering tools we use ourselves in the same place, these changes just aren't very visible. But our companies must use these tools. That's because industrial applications and industrial software are that essential to us. Right now, accelerated computing and artificial intelligence are driving innovation in these industrial tools. They're essential elements that form our industry's foundation. And now, for the first time, we are standing at that turning point. Going forward, we will completely transform the industrial software industry through this technology.
No matter what you dream of, the beginning is important. Be ambitious and grow little by little every day. Enjoy today's journey. Even if dark times come, I'm not afraid. Retire with United States stocks.